Are you a business owner in Canada and you're looking for ways to be tax efficient with your retained earnings and your savings? Well, I hope you are, because that's the whole point of being a business owner. Now, have you been through a handful or even just one life insurance pitch on how it can help you save on taxes? I've been through plenty. I never really understood it until I went for a walk with my great financial advisor, Joe Tablin, and he walked me through with some nice analogies exactly how insurance can be tax efficient, even if you compare it to making money in ETFs with your corporate money, and or of course a high interest bond account. So instead of feeling like you're trying to read a strategy in Spanish, just like a book, I'm going to break it down in the most simple English, business owner to business owner, on at least ways you can get curious about asking your financial advisor when it is time to think of an insurance policy to contribute to grow your money, and of course, cover your family with your assets when and if you pass away. Okay, so with that, let's get started. First things first, you have, let's say, $100,000 that you're investing right now through a corporation, okay? So it could be in a 1% savings account, you're making, 1% or $1,000 a year. Of course, you're taxed on that. Or it's in an ETF and you're making 6%, right? Now, of course, that also has a tax bracket on it as well, especially if you're getting dividend income that's taxed 50%. So you're really getting 3% in that case. So what do? Well, with a corporate insurance policy, there's a way that money can grow, but we're going to go through the different layers of growth and at what point you can break even and even surpass your ETF, or of course your high interest savings account, with the way that you can use this insurance vehicle. And again, everything I say, you can double check with your financial advisor, but here is my understanding and a way that you can at least get more familiar and get more proactive on how you make sure that you are tax efficient with your hard-earned money as a business owner. So instead of buying stocks with your extra saved money or corporation, think of you buying a insurance house. So literally your insurance policy is exactly like how a house functions. It has equity, it grows in value, and you can borrow against it, okay? So let's go through a brief example of exactly how those mechanics work. In this example, Joe talked about a certain business owner, they're in their 50s, and they have a family, and they've got retained earnings. And look, the most important part of a policy, let's not try to hack it and completely overlook the main purpose, is that you pass away, when the transfer of wealth happens to your estate and your family, you want that to be tax efficient, you want there to be a coverage. In this case, he's gonna get $2.5 million paid out to his family, as long as he contributes every year, and that's tax-free. That's the main reason. Now, the way he built up to it in this example, is, your situation will be different. He's contributing $70,000 a year to the policy, okay? Out of the $70,000, about 25%, call it $55,000, is what you actually keep out of the $70,000. The rest goes to insurance costs. That has nothing to do with what you get paid out or what you can leverage. So about, in this case, $15,000, that gets used to pay for expenses. You retain $55,000. So again, you're basically paying 25%. And that $55,000, like a house or even like a stock, is growing 4 to 6%. So that's actually being invested in a specific investment account in the market through the insurance provider. So it's equity that's growing, okay? So this business owner is repeating, paying $70,000 a year into the policy, $15,000 is for expenses, and $55,000 starts to be added up, and you can basically start to stack it. Now, you're thinking, I thought, 25% cost on my $70,000, that's a lot, Joe. Why would I do that? Well, he said, let's put onto a spreadsheet. At what point have you broken even on the $15,000 of costs that you pay every year? If you're putting in $70,000 total. Basically, if you mock that up, after 5 years, based off a compound interest of up to 6%, could be more, could be less, you've basically got enough in the insurance policy to offset all the $15,000 you've been paying off every year to interest. So basically you're at break even after about 5 years. So now you're going to be, essentially profiting, right? So you've kind of amortized your cost. Now you're break even. And now, of course, you can take it to the next level in terms of what you do on actually borrowing that money and even growing your leverage more. Okay, so that's breaking even on your costs. But let's actually go back to the example of you're paying into an ETF. The passive corporate income tax is 50%. So instead of 6%, you're getting 3%, but you're not paying 25% upfront, right? Of the what you put into the insurance policy. Actually, if you got 2 horses and it's 6%, no cost, but 50% tax on an ETF in your corporation, or the insurance policy where you pay 25% of your monthly cost-ish, right? So the $70,000, $15,000 goes towards cost. When do these guys break even? The math that we ran, essentially after 10 years, your life insurance policy, even though you're getting charged 25% every year for insurance costs, but you're not getting taxed 50%. That will outrun the other example where you're just paying 6% back, half of it's taxed. That's going pretty slow relative to 4 to 6% over, again, 10 years. So general math, obviously go into a spreadsheet with your own financial advisor and look at it. But just, I'm always thinking, well, how do we poke holes into this? So number one, a lot of costs up front to actually have the policy, but that can break even after about 5 years. And if you're comparing to your opportunity cost, assuming it's about 6%, after 10 years, the insurance policy has outrun all of those other options. And now let's get into the actual magic of where the insurance policy, before you die, actually grows wealth and helps you out. The example again was your insurance policy is like an insurance house. So back to the example of the business owner, he's paying $70,000 a year into the policy. Yes, paying some costs on it, about 25%. But after 5 years, he's at about $350,000 of what's in the policy. Now, like a good old house, he can actually take out about 80% of that. So loan to value 80%. So he's got 20% equity. He can take out about $280,000 and put that into, let's say, an ETF that gives him back 8%. Now, what's the cost in this example of him being able to talk to a bank to be able to get a loan of $280,000, which now they have collateralized his life insurance policy? Call it 5%. So he is paying 5% interest costs on a loan of $280,000 secured against his insurance policy, not a house, but it's an insurance house. And then that's making 8% of the market, right? Now, the net of that, of course, is you've got 8% that you're getting back, 5% that it costs you, and that's not getting taxed. So anyways, that's another layer of a bit of an arbitrage on, you've got this insurance policy, it's a guaranteed asset, banks can lend on that, you can use that for more expensive and rather profitable investment. Obviously, there's caveats, the market could go the other direction, it may not go to 8%, but here's another example where that leverage might help you to just invest more in the market, or you need that leverage to buy a property or pay off more expensive debt. Point is that your insurance policy is like a home. It is an asset, it can be lent against, and you can do very creative things with it. So that's another layer on top of your insurance house where it can be useful, on top of it making 4 to 6% a year in a tax-free manner. Okay, pretty cool, hey? Let's go to the last layer. To conclude, of course, the last layer is, unfortunately, you finally pass away. So what happens? Well, that policy now gives you, in this case, $2.5 million that goes to your family tax-free. Now, the $800,000, to my understanding, that's basically your equity of what it took to build up to the 2.5. So you don't get that back as well. The $800,000 that you put in is swapped in for $2.5 million that tax efficiently is given to your family. There's other layers as well on how you can transfer wealth to your family through the policy. But that's another topic. Talk to Joe. And to recap, again, life insurance policy has many different levers to it. If you do it long-term, of course, you assume mid to long-term market growth. And you, of course, have more and more assets that you're saving in your corporation that are getting taxed. Again, probably at 50% of the passive income tax credit, or rather charged to corporations. Then, run numbers in your case, and you'll see that, number one, it protects you for when you die to transfer wealth at a much higher multiple of $2.5 million. Also, it can grow 4 to 6% in ETF, layer one. Layer two, you can actually leverage and take out equity out of your insurance house to invest in the market to get higher returns. and or pay out more expensive debt. That's another layer of wealth, of course. And lastly, when the inevitable happens, you have cushion to pay your family in a tax efficient way. In this case, $2.5 million. So yeah, lots of levers, and I hope that gave you a bit more ideas on how life insurance can be a great vehicle of wealth transfer and growth as you are protecting your retained earnings that you've worked so hard to keep. So with that, I hope today was useful. And to my fellow business owners, keep being smart about how you save money and, of course, how you give your family peace of mind and security. Hope that helps. Again, I'll leave Joe's information in the show notes below. And if you have any questions around, of course, mortgage needs, we are a mortgage company. We work with people like Joe in terms of the best leverage strategies to grow wealth and to have a better quality of life. You can touch as well. So with that, thanks for your attention. Good luck. And most importantly, stay healthy.